Nice rally on our hands today. S&P 500 hitting a record high on the heels of strong economic data this morning. What does all of that mean for the Fed's path going forward following last week's jumbo rate cut? Let's ask Richard Clarida. He's the former Fed vice chairman and now PIMCO global economic advisor. It's nice to see you again. Welcome back to our program.
Glad to be back.
Were you surprised at all by the 50?
Well, we said it was a close call, and it was a close call. By my count, 9 folks were leaning to 25, 9 to 50, and I think the chair broke the tie. But, you know, looking ahead, it looks like a pretty sensible path, so I think let's look ahead.
I mean, let's do that. Well, let me ask you one question looking back. I mean, the dissent that we got from Bowman, how should that be taken? If you were still with the Fed, how would you take that?
Well, it is the first dissent by a governor in 19 years. Reserve Bank presidents can and do dissent. I think it indicates that it was a close call. I do think, you know, Jay Powell is very persuasive, and ultimately he persuaded the other 10 voters to support the 50.
So how far and fast do they go from here? And let's not talk about next year. Let's fixate here on the rest of 2024. What do you think happens?
I think it's pretty finely balanced. I mean, certainly given the robust economic numbers today that we saw, that reinforces, you know, the case that they laid out through the projections, which is a 25 basis point cut in November and December for a total of 50 more. You know, on the other hand, the communication from the committee, Governor Waller, Chair Powell, President Goolsbee, and others has indicated that they're really looking at the labor market. And I do sense that if we got any softening in the labor market data, in particular, say 2 or 3/10 rise in the unemployment rate, they would probably be inclined to go 50 again. So right now, I think we've shifted from a Fed that's looking almost exclusively at the inflation data to a Fed that's looking a lot at the employment data.
No, but what do you say to those who look at the data today, for example, and say, you see, I mean, they didn't have to do 50, and they shouldn't really be doing much cutting at all, because this is not an economy that needs any sort of help from the Fed at this point. The obvious other side of that is, well, they're just too restrictive anyway, so the current rates make no sense relative to where their inflation projections are.
Well, I think, Scott, you phrased this in the correct way. You know, the real question is how restrictive is current policy? Certainly the federal funds rate is well north of inflation and north of their estimate of you know, the neutral rate. You know, on the other hand, financial conditions by the Fed's own index are rather easy, and if anything have eased even more since the rate cut. And ultimately, this is about demand and supply. And so I do think they'll be open-minded as we go into next year. I don't think they're on a preset path, but I think there is a scenario where rates don't come down as fast, certainly as the markets think, which is a very aggressive path where rates are down another 200 basis points in the next 12 months. We may not see that.
Is their neutral rate right? I mean, do you have a good feel as to where neutral really is? The Treasury Secretary and former Fed Chief Yellen today said, yeah, they're going to cut to neutral. Do we even know what that really is in this current environment?
Well, the short answer is no. It is an important input to policy, but there's a lot of uncertainty. Indeed, the chair made reference to that last week in the press conference. I think there is broad agreement that the funds rate before the cut last week was above neutral, even the high end of the estimates. So I think there is probably some room to get rates down. But I do think that uncertainty becomes more relevant, you know, the more rate cuts that we see.